Good afternoon, everybody. We are starting the afternoon session of the Artificial Intelligence in Finance Conference. We had a very successful morning with very interesting talks, and we are also going to have some really interesting discussions this afternoon. But the first session and the first talk will be given by Michael Stutz. He's a Master's of Science in Quantitative Finance and Economic student, almost about to graduate, who defended his master's thesis 2 days ago. He has a really interesting topic to discuss, synthetic playgrounds for reinforcement learning in finance. Since we had one cancellation this afternoon, we have a little bit of room in terms of the timing of the talks. So we would let Michael present all the charts and everything that he wants to tell us. All right, come on over, Michael.
Okay, microphone works, slides work. No, they don't. What's up? Lift it back. Like that. Okay, good to go. Yes, I get the wonderful pleasure of starting off the afternoon sessions. This has been a great conference so far. I'm so glad to see so many faces, and I know that last year I chose the topic of dynamic hedging on like lattice trees, like binomial trees and options pricing. So I picked a simpler one this time for data synthesis to train reinforcement learning agents. This is a kind of a section of the thesis work that I've been working on for the last couple of years. Definitely hope it is thought-provoking. It's quite an interesting topic, for sure. So humans have really had in the back of their minds, in the figment of their dreams, the idea of autonomous agents that could perform tasks at or superior to any human. We've gone through the machine age where we were able to program things, and now we're into this thinking machine age. One of the more promising aspects of that kind of forefront of technology is the advent of reinforcement learning, which is sequential, autonomous decision that updates, or decision-making under uncertainty that updates itself as it acquires new data. It's a fascinating result that we've been able to see. And when reinforcement learning is brought up, generally you go through the classical video game examples, more or less. Reinforcement learning is trained in a playground of the gaming world, effectively. One of the interesting aspects, though, is like you had earlier in Dr. Hilpisch's discussion, he mentioned AlphaGo, and quite a few other people use AlphaGo as a significant reference point. In the financial context, I remember I was in a workshop with Dr. Hilpisch some years back when this idea kind of came to me, that we always talk about comparisons of decision under uncertainty in a financial context to like, how do we adapt a gaming context to the finance context? Well, it kind of occurred to me that the corollary to finance wasn't actually Go or chess, because they tend to be deterministic after a certain point. I mean, there's only so much finite space within the board that you can move. It would be something like the successor to AlphaGo that DeepMind did, the AlphaStar project, which was on the game of StarCraft. And for those who don't know, StarCraft is effectively a real-time game of asymmetric warfare, where the vision is ephemeral, asymmetric, and you can't always see everywhere at the same time. You collect resources, you build armies, you fight an opponent or opponents who have the same constraint. It's a very stochastic environment. You can't quite pin it down. If you could not brute force your way through StarCraft effectively. Which kind of led me to the thought of, okay, well, if that is a stochastic environment and the financial market is kind of a very stochastic, near infinite environment, what are the similarities? They're actually quite numerous. If you look into something like StarCraft and the financial markets, they both operate under hidden information. If you want to see what your opponent is doing, you have to sacrifice resources, you have to sacrifice time to go scout, to go see. It's the same in financial markets. If you want to know what the shipping industry is doing, you have to spend time or resources or data to go see what's going on. You can't just, it's not just given to you. You have to actually expend energy to find it. There's delayed rewards. You're building a composition of an army now in StarCraft such that you hope that it pays off in the future, that it counters the army of your opponent who you can't see, generally speaking. So there's this investing idea that is similar in both environments. Finance, it's you hope your portfolio accumulates value, basically. There's an adapt or lose component where it's non-stationary. You have to be updating continually, both to what your opponent is doing in real time or what the market's doing in real time, and also be adapting to the future perceptions you have of what are going to occur in the future. You have a foot in both ground, the now and the future, which is a very kind of unique and interesting setup. Additionally, there are unlisted here, but there are other kind of trajectories of financial markets that overlap with StarCraft. Like value of your army is accumulated but lost quickly. So you kind of have that escalator up, elevator down effect that you have in finance as well. There's almost kind of a thing of like a comparison of volatility clustering, where skirmishes lead to battles, basically. So any type, it's mostly calm, and then it's not. So there's these sudden bursts of activity. Where they differ, however, in kind of my pondering and research over this topic, I realized that happens to be one of the most important questions in quantitative finance at the moment, which is one of data. How was DeepMind able to take the AlphaStar agent and reach a Grandmaster ELO in StarCraft 2? Well, it was because of the training. They were able to play as many games as they wanted versus as many varied opponents as they wanted, continually pressing the restart button. Every new game was an entirely new environment. That does not exist in finance. You cannot go back to 1950 and press the play button and expect an alternative history. So you're bound into one specific temporal bound. Thus is the proposition for my thesis work, which is, can you craft synthetic playgrounds such that basically mirror markets as accurately as possible, such that when you embed reinforcement learning agents in there, are they able to fit the signal rather than the noise? If there are 3 main events that happened in the historical data set, what happens if they see 20 in an artificial world? Will they learn to abstract the behavioral characteristics rather than just the timing? In such, like the effective attempt is to emulate the success of StarCraft in something like financial context. Like I had said, most of the research done in reinforcement learning is not in the financial context. You really have to go out into the weeds of YouTube, archive, random papers that people in computer science have written. 2 interesting examples, I think, give kind of a broad vision of effectively the problem that are faced, especially in finance. One of them was by a researcher named Witten, who trained a reinforcement learning agent to beat the game of Pokemon from start to finish, basically. So every round, he starts at the same point and progresses linearly through the game, just one after the other. Keep training, keep training, keep training. The agent got so smart, quote unquote, that it effectively started reverse engineering the random number generator behind the random events in the game. It had become so aware of its environment that it basically could predict what was going to happen. It knew the exact path that was the optimal path, and it took that problem. It had seen that so many times that by the time it got, 4 or 5 minutes later into its run, every new experience that it had took exponentially more compute to bypass. So its weights were heavily front-loaded to the beginning because it just saw the same thing over and over. Contrast that to another researcher named Yosh in another video game context called Trackmania, which is a racing game. Similar problem happened. Since it's a racing game, obviously there are turns. It would do turn 1 through 2, 3, and learn those perfectly. 4, 5, and 6, it struggled with. It would just drive off a cliff, basically, because its weights were so heavily front-loaded. If you train at every epoch, what's the first thing that happens? Oh, I take a left. It knows to take a left. The researcher thought of a way to get past this, which was, what happens if at the beginning of every training epoch, I randomize the position of my car's start so that I see a new turn at the beginning of every training? What happened was that after he trained it in this kind of round robin way where he's just running through the turns, when he put it back onto the track, it was able to generalize. It could complete the track, and then after training on the track afterwards, it got world records. It was able to surpass human behavior at that particular challenge that it was given. This kind of in a way mimics financial context. I mean, effectively what you're doing, if you are training something like a reinforcement learning agent or any other kind of generative, like any other kind of decision under uncertainty optimization model, you are effectively repeating the errors that happen in the Pokemon example. You're overfitting it to the temporal bounds of what's happening. So how can we echo the lessons that you can learn from that kind of randomized start and adapt to make that a little bit more fleshed out, a little bit more nuanced in how it's actually implemented? To that, I made two different synthetic playgrounds, basically. One is based off of the classical stylized facts that you see in financial time series. It's the classical, basically brought out of the options pricing and volatility modeling world. So a jump diffusion mixed with an advancement on the Garch model, and kind of a novel Fourier block shuffle that is effectively, and I'll show in a bit, but it's effectively mimicking what is seen in the Trackmania example. And then further on, if that doesn't quite do it, I made a machine learning AI-driven, kind of data-driven version that it's called multifractal generative adversarial network that basically looks at a lot of constraints and a lot of different characteristics of the underlying data set and tries to replicate as accurately as possible. It's very complex, but it works quite well. And effectively what we found was that its ability to handle shocks was significantly better. If you can think of, just to give some terms as well, like these events that come out of left field, these unpredictable events, we tend to term as black swans. It's kind of like the last couple of days in the stock market kind of a thing. They've got to be big enough. They've got to be rare enough. There's another, you can think of them like your likelihood of being struck by lightning at any given point. They're statistically impossible to predict on an individual level. You can't look at any of us and be like, we're going to get hit by lightning tomorrow. It's not like a feasible prediction to make. A Dragon King is what happens when you kind of localize that and start asking yourself, okay, well, does the probability switch conditional on, am I sitting on top of a building? Do I have a lightning rod in my hand? Is it actually storming? That's a very different probability than the global probability of it just occurring blankly. So our idea is, if we get these synthetic sets right, will they be able to look at a crisis, see kind of the indicia of it, and prepare themselves for what's about to come, regardless of how the actual crisis manifests? Starting with our first architecture, our JDAT model, this is kind of a high overview architectural view of it. The main components of it, the three pillars, are really built off of, again, our stochastic volatility model, which is our APARCH. It's capturing that volatility clustering that I said and has been talked about, where yesterday's volatility is a great predictor for today's volatility. Basically, it kind of chains through time. And leverage effect, which is that if I lost yesterday, it's likely to be more volatile tomorrow than if I gained yesterday. Mixed with the jump diffusion, which is effectively, if we took all of that volatility clustering and leveraging out of the returns that we're analyzing, like what would be left? Theoretically, if we brought all those weird idiosyncratic things out, it should be like a Gaussian normal distribution. It's not, generally speaking, but like what's left over? After you've taken out the volatility action, after you've taken out everything else, what is that? It's the indicia of jumps, basically. Like what you are seeing is the leftover jumps. So this jump diffusion implementation is basically calibrated off of what's left over after the APARCH, and it gives us the likelihood, the severity, and the spread, basically, of any jumps that would occur into the series. And lastly, we have kind of a novel implementation. It's like a smarter version of bootstrapping, Fourier block randomization, where effectively we're decomposing the conditional volatility series and figuring out what dominates in that series. Like, what's the most important wavelength in that series? Figuring out the length of that, and then slicing and shuffling that, permuting that per simulation, basically, such that we've broken beyond the traditional, like just conditional volatility series, and now we're seeing a new random one where COVID might occur in 2000 over time. And here's kind of the empirical results of what that ends up looking like. There are three stochastic models that we're using. The first one, constant volatility, is basically just a geometric Brownian motion. Constant volatility, constant drift. It's just, so what we're looking at as well is a quantile plot. The diagonal line going through is the normal distribution, basically. It's a theoretical normal distribution. The blue dots to either side of it are the real observed returns. And what we're looking at is the last 25 years of the S&P 500 daily. And you can see that about at the second quantile on either side, the normal fit completely disappears. It's non-normal past those ranges. But we can see that, and it's replicated by the fact that the constant volatility, which will give you a normal distribution, does not fit at all in any point in the series. Our shuffled volatility model is basically that stochastic shuffled volatility scaled by a geometric Brownian motion such that it's capturing all of those weird volatility clustering kind of hills that you see. But even that isn't quite, it's explaining a lot of the non-normal behavior inside of the series, but it's not explaining all of it. Moving to our JDAT model, we can see that once we add jumps on top of that shuffle volatility, it does a much better job at capturing the distribution, the spread, kind of the profile of the underlying data set. That's not everything, but as you'll see, we move on to a higher volatility comparison for a case study. This is Tesla since it IPO'd in 2010 to current, so the last 15 years. Again, constant volatility, you'd be wrong at every single observation, basically. Shuffled volatility, basically what this is telling you is that the fit of a Garch model explains almost none of the extreme movement inside of Tesla. Some other process is driving the non-normal returns that you're seeing at the tails. And you can even see that even more when you account for calibrated jumps. Not even they are explaining it. It does a very poor job fitting both extremes, both the high side and the low side of the tails, which leads us kind of to, we need a better model. Like what exactly, like where do you go once you exhaust a lot of the classical methods for it? Where do you go? Which leads us to our generative adversarial network. GANs have been around for a while, since about 2014, I think was the original Goodfellow paper on it. But effectively what they are, to explain them for a moment, is they're these little complex algorithms, but they're best thought by analogy. You can think of them as two different agents, one of them an art forger and the other one like an art expert. And one of them is trying to produce, they're looking at like a real thing. So say in this case, returns, and they're trying to create ever increasing complexity of forgeries. They're trying to create perfect fakes. And a discriminator, which is kind of like our art expert, our police division, is trying to examine these fakes and be like, is this real? Is this fake? This creates an adversarial loop where effectively the generator creates the best fakes that it can. The discriminator judges whether or not those are real or how real they are. And through loss functions, passes instructions back to the generator that help the generator improve its synthesis process. What this gives us is very realistic data at the end of it, especially, very broad and very varied as far as how you can condition and train these generators to produce synthetic data. The high-level overview of MFGAN basically it's basically composed of four main parts. The first one is our volatility, basically emulating what was done by the Fourier block shuffled A-Parch fit, basically, the conditional volatility. It's using a model called a variational autoencoder decoder. And effectively, instead of just, what it does is it'll take the conditional volatility series, compress it down into a probabilistic representation of itself. I inject some jumps in there just to make sure that it's a little more varied than the standard like latent representation, and then synthesize a new series out of it. So it, instead of shuffling, it's creating an entirely new realistic series. It's kind of a mini version of a GAN inside of itself, basically. But it's capturing the short memory, which is kind of like any of the autocorrelation and volatility, even any of that like clustering, the weird behavior that we're seeing, it's emulating that. The next component that we have is, as mentioned earlier, a hidden Markov model. It's basically capturing what you would consider long memory. Effectively, what it's doing is going through each observation, and every day has a state. Every state has a certain characteristic return and volatility profile to it, and it's assigning states to every day, basically. So it's the long memory, like what, are we in a bull market? Are we in a bear market? It kind of detects this kind of stuff programmatically. We combine those two inputs, we turn them both into a vector and use them as conditioning elements on the generator and the discriminator such that they see both forms of memory, both short and long, and they understand that memory can exist. The generator's architecture is, you could think of it, it's an LSTM plus attention, like Francisco was mentioning earlier, but it's, you can think of the LSTM in this case as like it's like a storyteller. It's looking through the original returns, the underlying return series, and it's kind of making like bookmarks. It's making notes like this was interesting, this was interesting. It's updating its own weights based on what it's observing throughout time. The problem with LSTMs is that they're short to medium term. They will forget, and especially in a very noisy environment like finance, they'll overfit to the noise, basically. They will learn a crisis and then kind of forget about it as time goes on. To prevent that from happening, you can stack what's called an attention layer on top of it. That is more like, think of it like the functionality of a book club. Effectively, what it is doing is it's examining the narrative that the LSTM has produced and saying which parts of this story were important and updating the global weights such that they account for any of that past information if it's perceived to be relevant to the current day. On the other side of it, we have our discriminator, which instead of an LSTM is using convolutional layers, which come out of like image recognition and computer vision. Effectively, what they're doing, you think of them like cameras, they're taking pictures of little local patterns that they're finding throughout the return series and passing them to another attention layer, which is effectively working like a detective. It's piecing together all these different pictures such that it creates a narrative that is much more aware of, again, if something happened far in the past, if this pattern occurred then and I perceive it to affect now, it better be accounted for my prediction for tomorrow, basically. So it holds that long memory. Additionally, there are multiple loss functions that replicate the stylized facts, like the tail shape, the leverage effect. I use an algorithm called multifractal detrended fluctuation analysis that puts out 3 really good measures of the total behavior, the volatility behavior of an underlying data set that are set as conditions or as loss functions. And basically what it means is that every single loop, every adversarial loop, the discriminator is comparing the real data to the synthetic data that's being produced by the generator. And it's comparing it like by what measures? It's comparing it through something called a Wasserstein GAN, but it's giving a continuous score that's like, how real is it to the distribution? How real is it? Does it fit the tails? How real does it fit the multifractal spectrum? And it just goes through this checklist, passes a score back to the generator, which enforces the generator replicate these behaviors perfectly. It's a very theory agnostic way to, and like empirically data-driven way to replicate stylized facts that we may recognize or may not recognize. Empirically speaking, what you end up seeing kind of for the observation here is on the left, we have a comparison just for kind of controlling sake of like what would happen if you used a classical method for data synthesis of bootstrapping. You're just literally drawing from the distribution of returns or a section of the distribution of returns. And you've perfectly fit the distribution. This kind of shows that, again, we'll use this as an example in a moment, but if you just fit the first 4 moments of a series, the mean, the variance, the skewness, and the kurtosis, and you draw from that, will that look like what financial data looks like? The answer is no, but there's more to it than that. But moving on to our JDAT model, which we already established earlier, you can see that again for Tesla, doesn't fit the tails, does a pretty terrible job. MFGAN, however, you can't quite see it because of the video, but it fits the upper bound of the tails perfectly. And in fact, the lower bound, it fits pretty well, and it fits the middle distribution almost uniformly. Like it does a very good job replicating the middle and both tails. And in fact, if you were to run it and do multiple paths out of it, the bottom tail more or less fans around and does what you would want it to do, which is sometimes it overestimates, sometimes it underestimates, and gives you a good range of behaviors in those extreme events on the negative tail. To test these, how do we test these? We use 2 reinforcement learning agents, and like one of them is a continuous model, the proximal policy optimization model that you can think of as a like an investor. Basically, it's got capital, and it can choose from its action space that it thinks is optimal how to invest that capital. So if the action space spits out 0.3 and it's got $1,000, it's going to give you a $300 long position and a $700 cash position, basically. But it can go from full long at 1 to full short at -1. We also have our discrete model, which is, you can think of it like more like an analyst. It's a signals generation agent, a double deep Q network. Its action space is buy, sell, or hold. It gives you signals, basically. For both of these, we've implemented a lot of transaction cost, slippage. In the discrete model, I put a lot of penalties in there to keep it from trading 50 million times, which is generally what these agents want to do if you put them in a frictionless environment. There's a smoothness penalties, things like that, to just keep it from flipping sign every 5 seconds. But importantly, the architecture for the DDQN is memory aware. It's an LSTM and attention-based neural network underneath the hood such that it's understanding past returns and how those may affect the future. But more importantly, it's using something called distributional reinforcement learning, which instead of just taking the mean prediction of the future and optimizing based off of that, because the mean prediction in the future of finance is mostly zero, like the drift is negligible, generally speaking. It will actually divide it up into quantiles and take the mean prediction for each of those quantiles such that it's tail aware. It understands when risks might occur and the probability of them occurring. We do the same thing in our continuous model, except we're using, for the action space, we're using something called a mixture, a multimodal policy or mixture of Gaussian policies. And effectively what it does is the continuous model is allowed to develop its own trading strategies. It could be aggressive, conservative, just gives it an option, basically. It will develop its own behavioral patterns for what it thinks is best to capture the predictions that it's inferring from the distributional reinforcement learning algorithm. Our training method, round robin on the respective data sets. So agent MFGAN is trained on data sets that are produced by the MFGAN agent, et cetera, et cetera. We're going to test the discrete model on the S&P 500 last 25 years and our continuous model on Tesla for the last 15. Don't freak out. Don't panic. These are returns that are generated using a testing methodology called trained synthetic test real. They are meant to show relative strength of the agents. They're not necessarily like magnitude correct. What they are is relativity correct. It's not online. It's not quite in sample, not quite out of sample, but you would have to do a lot to make this to be an online agent. But what it does show us is that MFGAN's performance significantly outperforms the other two agents. And in fact, how it does it is its master drawdowns. It has figured out what to do when crises occur. As a first example here, this is it on the price path of the S&P 500. Just again, test real. Buy signals green, sell signals red. It is effectively showing that it has learned, and where there's no signal, it means it's just holding. It has learned to just hold during bull runs and flash sell signals when crises are about to occur. That's effectively what it is doing here. More importantly, going over to the continuous model, the green shaded is the actual cumulative returns path of if you just bought and held Tesla. And ironically enough, the bootstrapping of the returns of Tesla basically taught it one strategy, which is just buy and hold. It didn't quite do anything elaborate. JDAP did not get enough information to really understand the characteristics of the data set. It lost money almost everywhere except for 2023. It eventually, after 15 years, did a good job, but that's not exactly good enough for a reliable strategy. MFGAN managed to basically beat its own little index at every turn, more or less. It's relatively speaking far outstripped the other two models, meaning it's passing far more rich information to its reinforcement learning agent. This is an example of, again, what you're seeing here is the average position over time. It's the position of the trading agent as it goes through that time series. And Bootstrap has one trade, which is just all in. It's just a line at one, which is full long position. JDAP does not have much confidence, and it's constantly flipping sign back and forth. It doesn't quite know what it wants to do. MFGAN, however, is developing very nuanced trading strategies where it'll tactically short. It will hold whenever it's supposed to. It does partial hedging. Like, it's a very intelligent agent based on how it's developed. Random is just if you thought trading was a coin flip, this is the result you would get. It loses money often to infinity and continues to do so. What you're seeing in this chart is a composition basically of the last two charts. It is the anywhere you see in a green and red, it is full flip from long to short. And as you can see, JDAP is going all over the place with its sign flipping. MFGAN is far more strategic with when it does it. It has developed far more like rational trading behavior over time. And again, Bootstrap just holds long. So where does that kind of leave us? Like, what exactly have we accomplished with this? Well, we've tried to come up with ways to capture all of the classical stylized facts that we know about, and then try to robustly generate or robustly create things that even the stylized facts we can't quite perceive, that may be too high dimensional. How would we capture even those? To that, we've made our JDAP model and our MFGAN, and MFGAN does significantly better, relatively speaking, whenever reinforcement learnings are trained on its data set. This effectively lets us break beyond the bounds of time. It effectively gives us 20,000 years to train on instead of 20. And it allows us, if you were ever to have like an AI first paradigm for trading or hedging or anything, you would need to fix this issue. This data issue is kind of at the core of all of these type of things. So that's what we've tried to do. Thank you very much. Any questions? Yes. Right. That would be an interesting one. To see it with Tesla would be an interesting one. Probably not bad, generally speaking. Again, I would have to do a lot more testing on the online, and it's testing reinforcement learning agents in like a live environment is actually really hard, because the classical like test train split that you would normally do in data science is irrelevant, because your actual like realistic test, like where you're testing it, is either like T+1, or in the case of a proximal policy optimization, it's updating its rollout like every 100 observations, or you can make that as low as 25 if you wanted to. So your out of sample period is max like 100 observations at any given time. If you're trading in a market on like 1 minute bars, that's like what, 2 hours? It's not a very long span of time to really like, unless you were to do it sequentially over time in a live testing environment, you need time to be working on your side to even gather that data. So it's hard to answer. I imagine it wouldn't be the worst strategy on the planet, just because of the behavior that it's learned. But open question. Probably next paper. Oh, well, I hope that answered it. Well, I think. Yes. What's up? Yeah. Right. Exactly. Because we're in the training period, focusing on like indicia and afterglow of black swans, the hope is that it doesn't just train on like, what do I do when this crisis appears? It more trains on like, what do I do when a crisis appears? That is a very different like strategic question, and it's a much higher order level of thinking, that if you can train a robot to do that type of thinking, it'll probably position itself pretty well. I mean, it might not be making the most perfect executions on the planet, but yes, I would assume that it would actually handle crises fairly well. It would be good in this kind of market, basically. Yes. I kept it small. I tried it on, like I said, SPY and Tesla, but the training time for a generative adversarial network and a reinforcement learning, like that's kind of a weakness of it, that obviously you could optimize it if you were doing it for production. But I trained it on the 2 examples because since it's a master's thesis, I unfortunately don't have an infinite amount of compute or time to do this. But I imagine, I mean, I tried to pick 2 representative samples of like a wild stock and the most calm you can get, basically. So I would imagine other ones would perform somewhere between the 2, basically. Is that it? Okay, good. Thank you.
Thank you, Michael.